Good morning, and welcome to the Daily Market Brief. Today we take a step back from the short-term volatility to reflect on a bigger, more strategic question. In a world marked by political uncertainty, trade tension, and economic slowdown, what remains the smartest and most resilient way to invest for the long term? The answer, supported by decades of financial research and real-world data, is global diversification through low-cost ETFs. Recent developments have shaken global markets. Tariffs announced by the U.S. administration have triggered declines in major indices, rising volatility, and uncertainty about international trade. Technology and manufacturing stocks have led losses, while investors have rotated into safe havens like gold and treasuries. Markets across Europe and Asia have echoed this instability, reminding us how interconnected the global economy truly is. In times like these, many investors feel pressure to act to sell, to sit on cash, or to find a safe corner of the market. But history has taught us something different. It has taught us that uncertainty isn't new. It's cyclical, and the investors who tend to come out stronger are those who follow a consistent, diversified strategy that does not rely on predicting the next crisis, but on spreading risk in a rational, long-term way. This is where global diversification comes in. The core idea is simple but powerful. Rather than concentrating investments in one region or sector, spreading them across geographies and asset classes reduces the overall risk without sacrificing expected return. This principle is the heart of modern portfolio theory, developed by Harry Markowitz, and it remains one of the foundational insights of financial economics. It tells us that by combining assets that behave differently in different environments, investors can lower volatility and increase the stability of returns. Diversifying globally means not betting everything on the performance of a single country, even if that country is your own. It means owning exposure to Europe, Asia, North America, emerging markets, because while some economies contract, others grow. While one country experiences political instability, another could be booming thanks to demographics, innovation, or monetary stimulus. Exchange-traded funds, or ETF, make this global diversification easier, cheaper, and more transparent than ever before. With a single ETF, an investor can own hundreds or even thousands of companies around the world, across multiple sectors and market caps. And they can do it at a fraction of the cost of traditional funds. This isn't just about theory, it's about what works in the real world. Over the past 2 decades, globally diversified portfolios have weathered the dot-com crash, the 2008 financial crisis, the COVID shock, inflation waves, and now renewed geopolitical conflict. They haven't avoided losses entirely, but they've recovered, and they've rewarded patience and discipline. There's also a behavioral advantage. Many investors underperform the very funds they invest in. Why? Because they jump in when markets are euphoric and pull out when fear peaks. A globally diversified ETF strategy, especially one that follows a rules-based allocation, helps take emotion out of the equation. It encourages consistency, and consistency over time is what compounds. It's important to acknowledge that no strategy is risk-free. Diversified portfolios will decline in global drawdowns. They won't outperform every year, but they aren't designed to win every quarter. They're designed to build wealth over decades. So if you're watching markets swing wildly, wondering what to do next, consider this. No one can consistently time the top or bottom, but you can consistently stay exposed to long-term global growth. And ETF broad, diversified, low-cost ETFs remain one of the most effective tools to do exactly that. Thanks for listening to the Daily Market Brief. Stay invested, stay focused, and stay long-term. See you next time.